when you have the bravery to imagine and the will to get things done. That's Africanacity. That's ABSA. Corporate and Investment Banking.
You're watching Africa Trade and Business. I'm Ntauling Lechela. In this episode, we take a look at challenges being faced by Tunisia's olive oil sector, and we discuss the outlook for Africa's commodities. So let's jump straight into it. Basic problems inside Tunisia's olive oil export sector, including access to financing, a shortage of bottling plants, and the dominant position of a handful of bigger producers are restricting its growth. Let's take a look at the detail in this package report.
Mustafa Mouktarawi's olive groves produce an award-winning oil. The Tunisian says he could make far more money by exporting his produce in labelled bottles rather than shipping it in bulk. But access to financing, a shortage of bottling plants, and dominant bigger producers make that impossible, he says. Tunisia is already one of the top 3 olive oil exporters, with a record $1.3 billion in revenue last year. But around 90% of Tunisia's average 220,000 tonnes a year olive oil output is exported unbottled. Most is sold to European countries, which blend it and re-export under Spanish and Italian brands at higher prices.
Although I won 5 gold medals in world competitions for quality in 2022, I still haven't ventured into canning due to its many obstacles and difficulties. The most crucial challenge is ensuring the product's availability for all 12 months. When a customer requests it to be packed and shipped, the product must be delivered to the client on time.
Mouktarawi says raising the money to expand his operations or build necessary storage facilities himself is difficult, and that Tunisia lacks enough bottling plants for olive oil, with priority going to the largest companies, adding that the difficulties faced by many Tunisian producers should concern policymakers, anxious to bring in more foreign currency from exports as the government navigates a public finances crisis. Houssem Saad is from Alert, a Tunisian civil society organisation focused on economic issues.
10% of exporters monopolize 70% of export quantities and have 96% of export revenues, while more than 51% of exporters can only export 1% of the quantities and have 1% of revenues. These are the individuals who export less than 100 tons per year. Why does this issue arise? Because the most crucial condition for exporting olive oil is financial. And banks are the ones selecting recipients for seasonal loans, so they can exert control over the sector.
Slow turnaround times at Tunisia's main Raids port are also to blame, according to producers. The World Bank said 2 years ago the average turnaround time was 18 days, around 3 times as long as ports in Morocco. Officials say Tunisia has ambitious plans to increase output of bottled olive oil. The state news agency said last year the Agricultural Ministry planned to renew older olive groves with new varieties. An official at the State Oil Office says measures including increasing customs duty on bulk olive oil exports and marketing the products outside Europe will improve the situation.
We're shifting focus to Africa's commodity market now. Abu Dhabi's International Resources Holdings recently secured a controlling stake in Zambia's Mopane copper mines. That move, according to Julian Grieve, co-head of Resources Sector Solutions at RMB, should see a trend unfold. He joins us now. Julian, thanks so much for your time today. Now, before we touch on that trend, I'd like us to just kick off with an overview of the commodity scene. We've seen a downward cycle in commodity prices, particularly the metal prices, on the back of subdued global growth as well as those geopolitical risks. Is a similar trend going to play out this year, or are those metal prices poised to grow?
Well, we're hoping they certainly have hit a bottom and are leveling out for a little while. I think if you think about where we were last year this time, it was a buoyant market, everyone was making plenty of money, There were a lot of very smart people in the industry. Now there are a lot of sweating people in the industry. And I think that the outlook for this year is actually one of more uncertainty. So in our view, the geopolitics are not really being priced into the market. So there's a lot of risk of things blowing out and becoming more complicated, and then prices spiking off the back of that isn't being priced in and isn't behaviorally being factored in. So we've seen the PGM complex, as you said, come off quite strongly. Lots of fears around China and the growth story there. But you've had some buoyancy in the market around the bulks and the energy complex. So you've really seen this kind of scattering of commodity prices that certainly I'm not used to. It's something that's a bit unusual in the market, to have gold up and oil up, but PGMs down and a lot of the critical minerals down as well. It's something that we haven't really seen before. So there are a lot of sub-dynamics playing out in the market, and it's going to definitely be an interesting year with lots of potential for surprises. What's interesting about that is that this hasn't been priced in, and that it's actually almost that market participants are taking the opposite view. So people are actually going long volatility, effectively buying insurance on commodity prices. And, in this case, they're selling insurance. So they reckon that it's not going to become more volatile. And that's an interesting bet to take.
It really is, because when you talk to a lot of the mining CEOs, I think a week or two ago I was chatting to Northern Platinum's CEO, and he was saying that he expects more volatility for the next 12 to 24 months. So it's interesting to see the kind of dynamics that are playing out from different players within the market, within the sector. Now, that mixed picture aside, on the continent, things seem really good. It seems like we've struck gold, apparently, as demand for critical minerals like lithium, copper, to name a few, have surged. Talk to us about what's fueling those dynamics.
Well, they're almost kind of two halves. It's great that you say we almost struck gold, because I think the gold players are the happiest in the market right now.
Definitely.
And a lot of the story in Africa, particularly in West Africa, has been about gold. And so we're seeing lots of M&A activity playing out there, also feeding through into Namibia with new projects coming onto the radar. And those counters are doing well. They're seeing good valuations. So that's almost like holding up the market and keeping a bit of buoyancy in there. The critical minerals, aside from copper, have almost fallen off a cliff. The people sweating the most right now are probably the Australian lithium miners producing spodumene, and that's cutting quite deep into the cost curve, and you're seeing that supply side being choked off the back of that. And I think this is really the headwind of the battery story not playing out as planned. So fewer electrical vehicles being sold at the moment. There's a big stockpile, big surplus of batteries in China, and it's going to take a while for that to work through.
And that's actually what I wanted to talk to you about. There's been, big headlines on the back of the EV euphoria being dead, and automakers kind of scaling back on or delaying their electric vehicle plans. Surely this does instill some sort of nervousness in the market.
Definitely. So if you're a producer, you're quite certainly nervous right now. But also the producers of the vehicles. You're seeing that Tesla's not having massive growth forecasts at the moment, a bit of shine coming off their stock. But I think this is part of a normal natural cycle, right? People get over exuberant. We think that overnight everything's going to transform, and then it doesn't. And then there's this sort of disillusionment that creeps in, and you return to more normal levels. Electric vehicles are still being sold in China. It's still the fastest growing market for EVs. I think that aspect of the transition is still going to play out.
Yeah.
Right? It's maybe not at the speed that we thought it was going to be last year. And next year we're probably going to have to revise our projections again. So it's going to come in those fits and starts, I think. But this is by no means the end of that trend.
Now let's zoom into the scramble for these commodities. We've seen many countries from the West as well as China pour money or just engage in more M&A activity with miners within Africa, right? But recently we've seen the Middle East take interest with an Abu Dhabi company investing in a Zambian copper mine. Do you expect the Middle East to continue to show interest within Africa?
Absolutely. I think this is the start of a trend, not the end of one. So Saudi Arabia is going to be a major driving force, and they've really kind of set their ambitions at moving away from being an oil-reliant economy and modernizing quite drastically. So from being a broader energy play to participating in AI and they're really looking to attract investment, skills, IP, and they're going out to source those critical inputs to make sure that their economy is supplied, while you have this kind of geopolitical battle between those poles of the East and the West also battling for them. So as Africa, our nations have often been a bit of the child of divorce, in fighting between the US pulling in one direction and you've got China pulling in the other. And now you've got this new entrant, which adds a completely different dynamic, who's not necessarily aligned, and they like to kind of play both sides and also play neutral from time to time. So this shakes things up quite a lot.
And we talked about just how West Africa, right, has been the main player when it comes to the M&A activity and the money that's been poured through by the East and the West. Now I want to talk about South Africa, right? We've had many analysts say that South Africa isn't best positioned to kind of gain from this trend, and that we don't necessarily have a critical minerals strategy. How can we actually take advantage of what's been playing out?
Well, look, I think that the cynicism comes in that if you look at our critical minerals fingerprint, it doesn't really match up with a lot of the stuff that we need. Now, I think that maybe that's a little bit short-sighted, because some of the main ingredients that we have, we're dominant in. So chrome is part of the story, and manganese are part of that story, and we have the biggest reserves, and we kind of dominate global supply. So I think there's a play in there. But also South Africa, I would say, is massively underexplored. So we've not seen that investment in people drilling holes in the ground to find new minerals for a long time. And there are a few brave souls who are venturing into that. Copper 360, Jan Nelson's trying to build out that story. And it seems very exciting. And if you can get that right, then maybe it'll change people's opinion of South Africa. So I think it's not necessarily that we don't have them, for sure. It's that we don't know what's there, and it's not very public. Whereas if you think about the DRC, the first thing that comes to mind is copper. If you think about Zambia, it's copper. So their kind of transition and critical mineral story is a lot clearer than ours in South Africa. And look, I think in general, in the resources space, we've got work to do in terms of attracting investment and convincing people that we're an investor-friendly jurisdiction when it comes to extractive industries.
Interesting things. It'll be nice to catch up with you again to see how things play out towards the end of the year. Julian, thanks so much for joining us today. And that's where we leave things for this week's episode of Africa Trade and Business. From me, Ndawling Lechela, and the rest of the team, it's goodbye for now.
When you have the bravery to imagine and the will to get things done, that's Africanacity. That's ABSA. Corporate and Investment Banking.